Hey, welcome to this episode of The Complete Advisor. Special treat, timely topic. This is one you do not want to miss. I've got Neil and Becky from Stonewood Financial. We're going to get into taxation, especially around legacy assets, and in particular, those legacy assets, family legacy assets that are tied up in IRAs. What you need to be looking at right now, what you need to be thinking about, challenges coming up, and a couple bold predictions on 2026 and what to keep your eye on. This is an episode you do not want to miss, so we're going to get started right now. And sitting across from me, I have two tax experts, and I'm going to go left to right. Neil �Wilding, great to have you here, and then Becky Swansburg, fantastic. You've both been on the show multiple times, and so our topic today, what we need to talk about, I'm guessing here, is legacy issues and Secure Act. Neil, where do we want to start?
Well, we can go wherever you want to go with this, Dennis, but here lately we've been kind of realizing the opportunity here. You have so many of our clients that have a majority of their assets in these tax-deferred vehicles, like IRAs and 401ks. And if they have a good income plan in place and they have done a good job saving, it means a portion of those assets have already become earmarked to go to the wife or to the kids. And if they're sitting in an IRA, because of the Secure Act and some of the changes that act brought, it just introduces a new level of risk. And that's an opportunity for us to do some planning around and make sure that we're keeping our eyes on the prize here. Like if it's legacy money, we should be focused on what instruments are going to pass along the highest amount of legacy value for the heirs. Like how can we put the most amount of money possible?
I love it. Okay, so let's do this though. Let's level set just for a second. And just to make sure we're all on the right page.
Sure.
And Becky, let's put you on the spot as an expert. So what has changed? What changed with the Secure Act, high level, that most advisors still misunderstand?
Yeah, this is a great question because the Secure Act was such a unique example of Congress not changing anybody's tax bracket rate. The Secure Act did not change anyone's tax rate, any brackets, nothing. But it changed taxes a lot for many of our clients. So it used to be when you inherited an IRA or a 401k from your parent, let's say, you had more flexibility to kind of figure out when you wanted to take money out of that account.
Yep.
And so if this was going to be a high income year, high tax year, I might just let that money ride. I didn't need it. We often call that the stretch IRA. We just didn't have to take that money. Secure Act changed that. Secure Act, Congress came in and said, okay, for most people that inherit an IRA, they're going to have to fully drain that IRA, that inherited IRA, within 10 years.
Yep.
And that structure change actually had a huge impact on savers. Because if you think about what that means, so let's say I inherit my parents' IRA. Well, I have my income needs set for this year, right? I'm not going to say I'm going to quit working for the next 4 years while I take money out of my parents' IRA. Maybe if they left me enough.
Yeah, exactly. I'm liking the sound. The sound so far.
So, but for most people, they kind of have their income in place, and so they know how much is going to be on their tax return at the end of the year. Well, now all this money they're having to take out of that inherited IRA, that is all coming on top of the income that they already expect. So all of that money is taxed at the inheritor's highest rate. So it's creating these exceptional tax bills because you can't spread that out. Within 10 years, you have to assume all of that tax liability, and all of that tax liability is coming at the inheritor's top rate. Now, inheriting money is great. No one is going to complain about paying taxes on extra money that they get. But when we look at our clients, they're not trying to make the IRS their heir.
Yep.
They don't want to leave these legacies where the IRS comes and takes a chunk out of them. So these strategies Neil's talking about, it's such an important time to have these conversations because I'm sure we'll get into this with 𝐲𝐵A and some of the legislative initiatives right now. Taxes are a little bit lower than historical averages. It's a great time to move money around.
That's a great. So Neil, are you seeing a lot of advisors maybe unintentionally creating tax landmines here?
Well, I think when you think about it, like if we were to just talk through in general, Dennis, where do you think taxes are going?
They're going up. They have to.
Most people are going to say, conventional wisdom says, yeah, taxes are on the rise. At some point, the math has to sync up, right? Yet, many savers, those same savers that say, yes, taxes are going to be on the rise, those same savers continue to defer their taxes into this rising tax environment. And so that's a situation where their behavior is just not synced up with their belief. And so that's the role that advisors can have here is say, we already agree that taxes could be going up in the future. Let's just address that and how we build our plans and how we mitigate risk. Let's just sync up our behavior a little bit and start treating this risk as it is, right? And we can allocate our portfolios in a certain way that helps address that risk.
Do you think are most advisors reacting to inherited IRAs? Or are they proactively planning for them? Are they getting ahead of that? Are they behind? Where do you think they're at on that?
I think it depends on the client. I think it's a little reactive that a lot of times it's the client bringing up concerns about inheritance and what they're doing, but it's such a natural part of the client discussion. When you're looking at assets and you have all this money in your IRA and the advisors are doing the income plan with them, so they know, here's the kind of piece of that IRA we think we're going to need for income, and here's the piece that maybe has to go to some medical expenses, but we feel pretty confident that this is the piece we want to leave to our kids or to charity or whatever we might have in mind. So it's such a natural piece of the planning process. I just think with taxes, advisors tend to think short term. It's like, what is today's tax environment? What's happening with the next election? What are we going to see with taxes? And when we're talking legacy, we're really talking about not the tax environment of today, but the tax environment of the future. And what I think advisors need to remember is we are always planning for the tax environment of tomorrow.
Yeah.
But the only time we can do that planning is in the tax environment of today. And we have a very ripe tax environment of today to do that in.
Do you think with that thought that as you were saying that, I was just thinking about like the news cycle, and it just seems like it's exhausting. It's a bang, bang, bang. So thinking like my attention span almost seems like there's a crisis like every damn day.
Yeah.
And it's I have another thing to add to the grandparent worry for my grandkids. To where thinking a couple, like you guys say, every election is a tax
government,
change.
yeah.
So what do you? We laid the ground, like we threw that out there with the Secure Act. But so what do you have your eye on? What's on your mind right now?
Well, what I look at is working with advisors to, and I mentioned it earlier, like keep their eye on the prize. Like, what does it really mean? So many people look at their IRA statement, and I say it's an illusion, right? You look at that statement and you think, okay, I really have, if I have a $500,000 IRA, they'll say, I have $500,000. But when you start thinking about it,
no, you don't.
Like that money hasn't been taxed. It's an illusion. And so what you have to do when we start doing, and this comes up a lot just with general Roth conversion planning, and it extends into the legacy. But it's like we need to look at the true value of an IRA dollar. And how much wealth can that dollar generate? And in order to do that, you have to look at the real number, which is the number that will be taxed, and that after tax, like how much money are they going to
get into your pocket?
That's right. And so that's where I help the advisor community do some analysis and look at, okay, what kind of wealth can be generated from a dollar if it just stays in that IRA, and then be able to compare that to, okay, what kind of wealth can we generate after taxes if we go through the Roth conversion process? And if it's for legacy money, that's maybe where we can introduce life insurance as an alternative to the Roth conversion. And what kind of wealth can we put in the pockets of our heirs, again, all after tax, if it were to be in a life insurance structure. And so that's the opportunity that we have here. Is while we do have uncertainty, the Secure Act is recent evidence that Congress can change the rules on our IRA money.
Yep.
And that just shows us and introduces us to this concept of legislative risk that we always talk about. But that's the planning opportunity that we really have here, is to keep our eyes on what really matters. And it's not the value on that statement.
Yeah.
It's the value that we can put into either the IRA owner's pocket or to the heirs if we're talking about legacy money.
Do you think this is, we've talked about this, and is it resonating? Do you feel like you're having to push more towards the life insurance? Is it like, I don't know, is it like getting your kids to eat broccoli? It's like, this is good for you. It's not as tasty as the sugary items here, but we need to be doing this.
We're doing a training here. That's why we're here at the office. And I started the session and I put a picture of the FedEx logo on the screen.
Yeah.
And there's a famous marketing story. It's one of the most famous logos in there. And I don't know, Dennis, do you know that the FedEx logo actually has an arrow?
I do.
inside
I
of
do.
it?
I happen
So
to
you've
seen
heard
it,
the
yeah.
story, right? So
Not the story, but I know it's there. Tell the
So
story.
the arrow's there. So a lot of people, me included, just saw FedEx, and you see it's written FedEx,
yeah.
but there's an arrow inside the logo. And once you see it, you can never unsee it.
Yep.
And that's the power of that logo. And we feel like the same is true. It's like once you see tax risk and truly understand the risk that Congress can change the rules and legislative risk, as soon as you see that can be just as much of a threat to our retirement assets as the market or as longevity, you just never see things in a different light. Like finally seeing the arrow. So that's what we talk about here, Dennis, is I'm trying to help advisors see the arrow, right? And that tax planning. And once you see it, you're going to change how you do things going forward.
What's the biggest challenge in getting someone to see it, Becky?
Well, for a lot of advisors, if you're in income planning, you're used to annuities, and that's kind of where your mind is, you forget that at some point these funds will pass.
Yeah.
And your future client is actually the child of your client today. When these funds go to that next generation, what cleaves them to you versus someone else?
Yeah.
Well, I can guarantee you having strategies in place where you've not handed them a gigantic tax bill with their inheritance.
That'll help.
That'll help. So I think with advisors, the biggest challenge is kind of where are we putting this in the process? A new prospect comes in, I'm working to get their income plan set up. And I think the real advisors that are seeing large-scale practice growth across the board are the ones that are able to not just say, we're going to fix your tax problem over here on income, but we're also going to make sure that we are optimizing and minimizing taxes and fees throughout the journey of your money.
Yeah. I have two brothers that are really big advisors, and my brother Perry. So shout out to family here. Yeah. We were having a conversation. He said that was one thing that he said was, tax management, tax mitigation is the new alpha.
It is.
And
that's
that's where the action is at. And what you just said made me think of something like, one of the big challenges for advisors is, you do have your top client, they pass, and honestly, I don't necessarily believe what some people say. From firsthand experience, it's super hard to keep the beneficiary.
It is,
because
absolutely.
they have their own advisor. But if you gave, like I can do for you what I did for your mom and dad, and look what I was able to generate is Karen, let's pick on Karen's.
Yeah.
Is your advisor Karen talking about this conversation? That would be a definite differentiator.
And the ability that now those heirs because you can have them participate in the structuring process.
Yeah.
And now you have connections with the people. They understand why you were helping their parents, most likely, with this structure and the benefit to them. You've created a connection that might not otherwise exist.
Yeah, a good shot at it.
So, yeah.
Yeah. And then, we always think about passing money from, parents to the kids, but also a lot of wealth is transferred just to a surviving spouse. And so we start looking at how money is passed, and we talk about risk. Like there are situational tax risks that become apparent in that, in the passing of wealth from one spouse to a surviving spouse. The industry has been calling it the widow's penalty, right? And that is present. And so if we can speak that into the language, and that is the risk that, if you think about, you have a working couple with a household income, they're married filing joint, and they're filing on married filing joint paperwork. And then you have a surviving, you have one member of the couple passes away, you have a surviving spouse. Suddenly, we have that same household income, but now we're filing on a different sheet of paper.
Yeah.
And just because we're filing now on a different sheet of paper, now we're using a completely different tiered system, suddenly our tax bill is much higher.
Yeah.
And that has nothing to do with Congress. That has everything to do with their situation. But that is a risk. And if we can help quantify that for our clients, in many cases, the widow's penalty can represent a 30% increase in their taxes. And many people might even just speak it, talk about it, but if you can actually quantify that and show plans and look at, I always use Barb and Bill, right? Like if you have a couple sitting in front of you, And if we can look Bill in the eye and say, listen, if you're not here, Barb is going to be in a very different tax environment than we are today.
This is one that most people, I don't hear advisors talk about that.
Yeah.
I honestly, out of all the advisors I talk to, they really, maybe they do, I don't think so, but I don't hear it brought up. And that's a big one. Because your intuitive assumption would be, well, if I'm not here, as long as the house is covered or whatever, I'm not here consuming, so he or she will be fine. And no one takes that into consideration.
Well, and if you could look at Bill in advance and say, hey, listen, why don't we try and satisfy this tax liability while we're on this other sheet of paper? And it can be extremely motivating. And that's one of the challenges we always face is how do we get people to act now?
And I would say one of the places in the passing of assets, at this moment, these legacy assets, it's where I think in the entire planning process, we see most acutely this marriage of these situational changes and legislative changes. So you have all these changes that happen when you go from joint to filing single, then to your kids having the money and it going on their tax return. On top of that, you have all these legislative changes about how money can pass, who it can pass to, how they have to access it, what bracket rates they're going to access it at. That moment of money in motion can cause a huge tax bill. And that's just, when we think about our clients, if we can frame that up for them, they don't want to leave their legacy with a due bill,
Yeah,
They want to leave it with the most money possible. It's a really important time to plan because it's kind of all these tax things that we talk about all coming to bear at once. That's such a great point. Do you get, when you're talking in there, a hand gesture to the meeting room down where you're meeting advisors, but do you get any pushback from advisors that aren't familiar with life insurance? Because I'm thinking of who's over in that room, and I know a couple people are just massive advisors, but I don't believe that they do. They might be neophytes to life insurance.
Well, I think it's interesting. I think if we started the training and we were going to say, hey, we're going to just talk about life insurance.
Life insurance.
Then, they're like, well, okay, where can we go get something to drink? And go But when we come to the conversation through the tax code, and through situational tax risk and through legislative tax risk, life insurance is the path. And so that objection doesn't happen.
We were talking this morning that, a lot of these advisors even, but also their clients, think of life insurance as this product. And we really have to change the thinking of that, particularly around these legacy conversations, that it is not a product. This is an asset allocation strategy that gets you certain features and benefits that you might want for your heirs. Guaranteed high levels of tax-free money when you pass.
Yeah.
And so I think that part of what we're doing at this training is having people stop thinking of, it's like this is not your father's Oldsmobile. Remember those old commercials? It's this is not the life insurance of the past. This new modern savings-oriented kind of life insurance, it's so flexible and it can serve a lot of roles in a comprehensive retirement approach because it specifically helps with legacy values and overcoming tax and legislative risk.
Yeah. And it is a conversation you do from my life insurance days. You do need to have sooner rather than later because you can have all the money in the world, but you still got to qualify for that doggone thing.
That's right. It's an exclusive club.
It is an exclusive club. It is. And for some reason, clients get, it seems like when you tell someone they're rated, getting into the weeds, when you tell someone they're rated, they seem shocked, but it's like, but your BMI is like 45, you're in great shape.
We had the
nudge,
opposite.
nudge.
When I got my IUL policy, I was pregnant with twins, and I had gestational diabetes, which is very common with twin pregnancy, and I'm also allergic to peanuts. And when we got it back, I was super preferred, and my husband just looked at me and said, "One peanut kills you. I can't believe they let you be super preferred. You're pregnant. You've got, the gestational diabetes." He's like, "They should have knocked you down." I said, "Honey, it's a much better deal for us."
There you go.
If I'm up. But he was a little offended maybe that our health was on equal footing there.
That's right. That's funny.
But it is. But, a lot of these, because these life insurance policies are overfunded, they tend to be structured to where you need to be able to qualify for it, but it's not as sensitive to having to be rated super high.
And it is so different than it used to be.
It is. And the other part of it, too, is like we have advisors that are hesitant to bring up the conversation, worried about underwriting. And really, we're just talking about an allocation, right? Like this is not a product conversation, as we just said. This is more about how can we reallocate you're overweight towards tax deferred right now, right? You start thinking about it in asset allocation model. And we just need to reallocate some of that money to the tax-free side. And if you qualify, might be able to use this one idea. But if not, then it becomes a Roth conversion conversation. But either way, you're having a conversation that the other guy or gal down the street's not having.
I love it. I love the I will get the title wrong, but the book that you have with the pencil on the cover.
The No Compromise Retirement Plan.
I like that. And then you guys just put together a new one.
Brand new book called The Road Less Taxed. It's how to take control of your retirement from Washington. And it is phenomenal. A message that people need to understand. I say this not just because Neil and I wrote it, but because we wrote it because there's this lack of understanding that all of this noise happening in Washington actually has a very direct through line to a lot of the savers in this country, particularly higher net worth savers. And it's funny, a lot of times the advisor community, we think of like ultra high net worth and, all these levels of net worth. I was sharing in this training, almost 90% of all federal income tax revenue comes from U.S. citizens that make $100,000 or above. Yeah. So every one of our clients that is going to expect to generate a six-figure income in retirement, they are the people that government is looking for to raise revenue from. They are the rich ones, according to our government, whether we classify them or they classify themselves as rich.
Yeah, everyone is let's get Bill Gates and Elon to pay
Musk.
the taxes, and it's like when they're talking the wealthy, they are talking about
you.
Look in the mirror.
So the book is really just uncovering what these risks are, and then how, with the help of a qualified financial professional, do you overcome them in your retirement and legacy approach.
Do you guys have your eye on anything? Because we are headed towards midterms this year, right?
Yeah, midterms, November.
Anything that you're keeping your eye on? And then I've got a question, a follow-up.
Well, that sounds like a Becky question there, really, from the midterm elections.
I think from the advisor perspective, actually, the single biggest outcome of the midterm election is not going to be any specific legislation necessarily that affects our clients. It's going to be this return of extreme political volatility. And, I've heard from savers, kind of coming off 𝐲𝐵A and the large tax reforms that were passed last year. There's kind of was like this sigh of relief, like, all during the Biden administration, we heard taxes were going up. Now 𝐲𝐵A's happened. They're going to keep taxes low. Do we not need to really worry about taxes anymore? And I think I've said on this show before, the thing that's driving legislative risk for our clients is not Republicans or Democrats. It's every 2 years we get new government. Yeah. It's this constant change. And so the midterms, I think the main messaging around it for advisors is going to be, look, we have this gift with 𝐲𝐵A of lower tax rates today, of the new deduction if our clients are age 65 plus. We have to leverage this tax rate environment to plan for what's coming ahead, because it's all going to change. And that change is going to be very close to people's hearts as this summer through the election. Yeah. Gosh, don't turn on your TV or radio if you don't want to hear the parties bashing each other.
So, it is such an interesting challenge that we have with the education of advisors but then the advisors getting clients to act, because we do have this every 2 years. We've got new legislators in there. We've got new things going on. Tax laws are always changing, and there is that tendency to just like, I'm fine right now.
Yeah.
Like, I don't need to act now. I was curious, how does state taxation play into the big picture?
Well, I think it's a big deal if you're planning on moving to a tax-free state. That might change some of the calculations. Yeah. So if we're looking to analyze, like, I think of the decision to convert or not to convert, like, not product-wise, right? But we have this dollar in an IRA. Basically, I'm asking, should I defer the taxes on that money into the future, or should I pay them now? One of the variables on that, if we're going to analyze that and quantify really the cost of deferral versus the cost of conversion, state taxes can be, because that's where things can change quite a bit. So if you're going to move from California to Texas, and you might want to pay those taxes when you're in Texas, right? But that's just one variable, right? Yeah. We can't just look at the one variable, because you know what? It might actually make sense before that happens, because taxes can change. Mm-hmm. And what if taxes go up? And what if the 9 other variables work against it? Yeah. So that's a long way of saying, which this is the answer to so many questions. it matters.
Yeah.
Right? It matters. And that's why it's nice to be able to analyze that and plug all of those, like what could go wrongs or what could change into your modeling. And I think that's what's important is for an advisor to be able to do that.
So in addition to getting in there and as an advisor, telling an advisor like, listen, you need to be looking at this now. You need to be looking at conversions if they make sense. What other areas, are there any other opportunities that you think right now that advisors are missing out on?
I mean, I think to me it's, well, and I've said it already here, so I'm kind of repeating myself, but truly keeping our eyes on like what are we doing for our clients? Like what is the, ignoring the statement value. I think people miss out on like in the Roth conversion conversation and moving money tax-deferred to tax-free. So many people just look at the tax rate that it is today and then make decisions for a lifetime based on what their taxes and their tax situation is today. We can't look at that. We have to look beyond that because so much can change. And so that's what I would encourage people to do is look beyond just the taxes and what the tax environment is on April 15th this year and start considering every single April 15th that we're going to have to experience over your lifetime and all the things that can change. And just model all of those changes into your decision. And I think behavior will change drastically when we start to do that.
It's interesting with the rise of AI. And, one of the things that I think is the real gift that advisors can still bring is that AI can give us all this analysis and all this more, but it doesn't help us identify what matters.
Yeah.
And it's interesting. I heard a podcast that had nothing to do with finance, but one of the speakers kind of presented this question. They said, look, in a world with AI where we can make anything and make it with ease, how do we make people care? Advisors are still the people that make people care. And so I think, it's not just about all these analysis tools and these reports and these things that you give your clients, but it's our ability as financial professionals to make it simple and, more importantly, meaningful to the client. How do we get into their fears and their concerns and then give them the relief that there are actually strategies that can address it? So the thing that I think advisors need to double down on, it's like on one hand, we're doubling down on AI and analysis and all these tools. And look, our company makes a lot of these tools. But the human piece of it, the ability to start a conversation with language around taxes, around why this isn't just some big, fog in Washington, but these are actually specific things that could impact the life you want to live in retirement. And then to come back with the support that I, as your financial professional, I have my eye on that, and I have a path forward away from the madness to the retirement you want, and I'm going to be with you on that journey. That's never going to stop mattering, and that is what people still desperately need more now than ever.
I 1,000% agree. I think that you can get the old paralysis by overanalysis. I was even I bought new tires for my truck. And you would think this would be just a slam dunk deal. But you start reading reviews. You start reading evaluations. I used AI. I'm like, I can blah, 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 because I wanted to go upsize the tire, blah, blah. I was doing all these things, and I'm like, I needed tires, and it stretched probably 3 weeks longer because I kept doing research.
Yeah.
And then, it's so much easier. You get so much stimulus that you're just like, wow, I'll just push it off.
And what if you had a tire expert that just said, you know what, I've
human.
done all that.
Yeah.
Let me tell you, tell me what you need, Dennis. I'll show you the tires
That's
you
actually
need.
what ended up happening because I got so sick of, I was looking at different things, and it's like, well, this makes sense, but this makes sense too, and this makes sense. And then finally I talked to someone, I'm like, hey, Bob, blah, blah. He's like, yeah, you want to go with the Coopers. And I'm like, okay.
All right.
Thank God. Let's put them on the truck.
So what happened there, and this is what I use a lot, is we have to comprehend the complex but communicate in the simple.
I could not agree more. Okay, so maybe a little Punxsutawney Phil opportunity here as you look forward. Because I'm going to get this podcast put out. So this is late February, hence the sweater because it is cold out today.
Yeah.
Becky, you get to start. Neil, you get the final thought here.
Close us down.
As you look forward, let's say the rest of the year, what do you got your eye on? Do you want to make a bold prediction?
Yeah, well, I think we have kind of two known anchor points of this year, and then we'll have many unknown anchor points. The two known anchor points is April 15th. We are coming into our very first tax filing season post-OBA. And for advisors out there, I still find that the number one source of confusion in that bill for our clients is this new tax deduction for seniors age 65 plus that's meant to offset their Social Security. So lots of education opportunity as we head into tax season. The minute we're done with tax season, all eyes on that midterm election, which is our other anchor. And I believe that the Democrats will lose control of the House. There's a path where they could lose control of the Senate. I won't be that bold to predict, but we are going to go back to having divided government. Now, sometimes divided government isn't bad government. I like a slow legislative process. I don't want us pushing through things anyway. But we are going to have a lot of political rancor this year and just kind of a lot of fighting. Yay, to look forward to. But
happy times.
I'm deleting Twitter.
Into that, clients are going to need to know more than ever that while what's happening in Washington is scary and upsetting and confusing, there are strategies and there are paths forward.
Yeah.
So I always like to say to people, you want clients to work with you so that when they're yelling at Fox News or CNN, it's just for their personal reasons, not for their retirement.
Yeah, that's a good point. Change and turmoil do always lead for opportunities.
Yeah.
Something doesn't feel good from when you're on the sidelines, but when you're in the game, it does create opportunity. Neil, what's going to Punxsutawney Phil? What do we got?
Well, I feel like the demand for Roth conversions will continue. I think a lot of our advisors have been doing Roth conversions for a couple of years and doing conversion planning. And some folks have said, well, man, now we have these permanent tax laws. Do we really still need to continue this? And the answer to that is an overwhelming yes. Yeah. And I do think you see the advisor community understands that just because we're in a short-term environment and Congress has not raised taxes in a little while, at some point they will have to.
Just has to be.
They will have to. And they're starting to do it with more subtle ways. Like I know other topics on this podcast, we've talked about 𝐼RA and other income related. So I think you will continue to see conversion planning be a large part of what advisors are focused on throughout the year. And I think you'll see even more attention to these income-related type taxes because we do, and we talk about this in our training, it does represent, we feel like, the future of taxation in our country is looking at income and looking at people that, are more subject to these income-related type deals. So I feel like planning around things like 𝐼RA and discussion of taxation of Social Security and dividends and cap gains, and people, when they go to pay their taxes, they realize, oh man, I had to pay more this year because I crossed over a threshold in all of those categories. It's just going to prompt even more planning opportunities in the future, and those discussions need to continue to happen. I think they will.
Yeah.
I have to put an asterisk on that too, and that is as an advisor, you really need to understand what those are. I had somebody after when we talked about 𝐼RA, they said, well, that's not that big of a deal. And it's like, no, it's every month. Too. They thought it was just a one time, and it's like, that's every month, and then bang, bang, bang,
every
these
month,
things build.
Every tier,
year,
and then per person.
Yeah.
So what could be, $145 or so turns into, several $1,000s. And when you plan that over a lifetime, suddenly it's a six-figure problem.
That's right. That's right.
And I think, this all falls under this broad feeling that I think what people are going to need as we go through 2026 and beyond is, they turn to financial planners sometimes like we can predict the future. And we're not mind readers. We don't have a magic ball. We cannot predict the future. But what we can do is plan and prepare for futures we can't predict.
That's right.
And it's a great opportunity in this time where people are so needing of, control and to know what's going on in this world to be able to say, hey, we can't predict what's going to happen, but we can prepare for that unpredictable future. And that's what, risk mitigation is all about.
Yep. I like quotes, and one that I saw a long time ago was like, we can't control the weather, but we can set the sails.
Yeah.
And as a North Dakota kid, that never made sense to me because we don't really sail much up there, but it makes sense when you think about it. All right. Well, I am excited to have you guys both or singularly on next time you're out this way. And we'll check back on those predictions, and we'll get this podcast put out. But
how embarrassing would it be if this election there's no volatility, everyone gets along, and no one's mad. My predictions will be wrong.
And everyone stopped doing Roth conversions.
That's right.
We would find something. We'd find something to be mad about.
That's right.
And but no, that's like you guys have both said. The tax code is written in pencil. And there's two, learn in hand, the two tax codes, one
Yep.
for the informed and one for the uninformed.
That's right.
And our job is to inform those clients.
That's
so.
right.
Yeah.
Thanks for having us on.
Yeah, we love coming.
Absolutely.
It's big.
Yeah.
We love it when we come to Kansas City. We get to do this kind of stuff.
I love
Enjoy it.
having you both on. For everybody else, okay, so we're going to wrap. For everybody else, though, if you have any questions, if you ever have a topic that you want us to dive into, let me know. Drop it in the chat, shoot me a direct message. Also, big favor to ask, like, subscribe, follow the show. That way, whenever we drop a new episode, you're the first to know. And then I'm curious what you think about what Neil and Becky said, so drop some comments in there and let's get a conversation started. So thank you, and we will see you next episode.